Hello everyone, my name is Patrick Kopek and this is Group 5. And for this project, we took on a role of analyst on a buy-side research team. Our goal was to evaluate a group of long-term companies' performance, both individually and as a diversified portfolio. The 10 companies in our portfolio include Barclays, Bank of Montreal, Flowserve, Macy's, Otis Worldwide, Pfizer, Provident Financial Services, Rogers Corporation, Somni Group International, and Western Union. And in this analysis, it covers from January 1989 through June 2025. This gives us a long-term view of performance across different market cycles. And we collected monthly adjusted closing prices from Yahoo Finance and imported FAMA French market factors into Python, and we automated the entire process. So let's start with Barclays. Barclays is a large global bank based in London. It operates in areas like investment banking, consumer banking, and wealth management, so it's strongly affected by global economic trends and interest rates. From our regression, Barclays has a beta of 1.37, meaning it moves more than the market. If the market goes up 1%, Barclays tends to go up about 1.37%, and it also falls more when the market drops. Its alpha is negative 0.106, which means it slightly underperformed the market after adjusting for risk. And the R-squared value is 0.29, showing that about 29% of Barclays' movement can be explained by the overall market. The rest is influenced by things like changes in interest rates, global credit conditions, or company-specific factors. Next, we'll look at Pfizer. Pfizer is a major pharmaceutical company known for producing vaccines and prescription medicines. And from our regression results, Pfizer has a beta of 0.67, meaning it's less sensitive to market changes. When the market goes up 1%, Pfizer typically rises only about 0.67%, and same applies when the market falls. Its alpha is 0.33, which suggests a small positive excess return after adjusting for risk. And the R-squared value is 0.19, showing that only about 19% of Pfizer's returns are explained by market movements. Yeah, this makes sense because healthcare companies are more affected by things like drug approvals, health trends, and many market factors. Now, let's look at Macy's. Macy's is a major retail company that depends heavily on consumer spending and seasonal sales, and because of this, it tends to be very sensitive to market changes in the economy, especially during recessions or periods of low consumer spending. From our regression, Macy's has a beta of 1.43, which means it's more volatile than the market. The alpha is 0.18, showing that it slightly underperformed the market, and the R-squared value is 0.28, which shows that about 28% of Macy's returns are explained by overall market movements. So we've looked at some of how individual stocks behaved on their own, and many people rarely hold just one stock. What matters is how the portfolio behaves collectively, whether diversification actually helps reduce risk and create smoother returns. So the next section, we'll present the CAPM regression results from our equally weighted portfolio, compare the beta and R-squared to the individual stocks, and discuss what it means for an investor risk and performance.
I will be discussing the CAPM equally weighted portfolio of all of our 10 stocks put together. So ultimately, the equally weighted portfolio does a couple of things. The beta is 1.12, meaning that is slightly more volatile than the market, which does make sense because it's a collection of a smaller number of stocks than the market as a whole, so there will be a little bit more volatility. There is a small positive return. Our alpha is 0.0016, which is pretty small. It isn't exceptional, but with the collection of these stocks, you reduce the volatility compared to if you had just invested in one stock. So it's doing a lot of that work of taking out a lot of that idiosyncratic risk that's inherent in investing in one stock and taking out that company-specific risk by combining them all into one portfolio. 62% of variation in the portfolio returns are explained by market excess returns, which is essentially just explaining that R squared that you see there. Compared to other stocks, the other stocks within this collection, there is a much higher R squared, which just means that the more the variation is explained by the market, and there's a more stable alpha. So some of the stocks in this collection of 10 have a negative return, some of them have a positive return, but by combining them all into one, you can kind of hedge out a lot of that idiosyncratic risk, and you're left with more systematic risk that you would have with any collection of stocks in the market. Again, like I discussed before, diversification is really key for reducing that idiosyncratic risk and trying to hone in on your returns by reducing that volatility and giving you the best returns. It also gives, again, more predictable behavior with this equally weighted portfolio compared to just investing in one of the stocks. You're going to have more predictable returns because if one stock dips, the other one can come up to compensate for that dip in performance.
And I'm going to be talking about the key findings and then wrap things up. So this first slide shows the efficient frontier, which is telling us the best possible mix of investments for different levels of risk. Each point represents a different portfolio we tested with varying stock weights. What we can see is that as risk increases, so do potential returns. That's the upward curve. The portfolios on this line are considered the most efficient because they give the highest return for the amount of risk taken. Anything below the curve means we could be getting better results by changing the mix of investments. This really shows why diversification matters. By combining different stocks, we can lower overall risk while still earning strong returns. Instead of relying on one company, we spread out the risk and create a more balanced portfolio. From an investor's point of view, this helps decide whether they're comfortable playing it safe with a lower risk or aim for higher returns and take on more volatility. Finally, to wrap it up, our analysis shows how portfolio optimization can help balance risk and return. By applying the CAPM model and plotting the efficient frontier, we can see exactly which portfolios perform best for different risk levels. Overall, the results highlight that a well-diversified portfolio is key to improving returns without taking on unnecessary risk. Instead of focusing on single stocks, spreading investments help achieve more stable and predictable performance. In real-world terms, this type of analysis helps investors make smarter, data-driven decisions, choosing portfolios that help fit their financial goals and comfort with risk. So our main takeaway is that understanding the relationship between risk, return, and diversification is crucial for building a strong, efficient investment portfolio.